Today, volatility false signals. Hello again, it's Martin North from Digital Finance Analytics. Well, latest post covering finance and property news. Well, many believe that the major financial markets are due for a further rapid correction as the recessionary forces mount following the most rapid heft in rates ever. And if you look carefully, some of the leading indicators for credit, defaults, and business failures do appear to be rising. And of course, household savings are being drained rapidly. But last year, of course, was a bad year for stocks, with the major US indices well down, and whilst this year has been somewhat stronger, the volatility has been pretty extreme. But investors wouldn't know it by glancing at what's often referred to as Wall Street's favourite fear gauge, which has recently failed to reach new heights, even as stocks tumbled to fresh lows last year. The volatility index, the VIX, better known, of course, as that fear gauge, was actually through 2022 not far off its long-term average, despite widespread pain across markets. The VIX is based on trading in S&P 500 index options, and it serves as an indicator of expected volatility in the index over the coming 30-day period. Now, after topping out at 36.45 on March the 7th, 2022, it repeatedly failed to make new highs for the year, even as stocks tumbled to their lowest levels in years in June and again in September and October. And it's currently sitting at a low of 1705, which begs the question, is the VIX broken? And is this why a new volatility index is being launched on Monday? Nicholas Colas, the co-founder of DataTrek Research, highlighted problems with the VIX in a series of research notes last year. Perhaps counterintuitively, he and others see the subdued VIX as a potential cause for concern. This is because a spike in the fear gauge has typically preceded stock market bottoms in recent decades. In fact, Colas and others refer to the phenomenon as capitulation, meaning that a surge in the VIX signals that sentiment in the market has grown so dire that the market is about to turn. And in fact, if you look back in history, the VIX surged above 80 before stocks bottomed out in March 2009 and again in March 2020. Colas has said in the past, levels above 40 are needed to signal that capitulation is at hand. Volatility typically rises fastest when stocks are falling, market strategists say. But the lack of a clear signal that bears are reaching a point of exhaustion has made some analysts wonder if the market's lows might still lie ahead. Volatility seems too low, said Danny Kutch, head of the options desk at Piper Sandler, speaking at the end of last year. I'd say the VIX should be at least in the mid to high 20s as opposed to barely 20. We had a really terrible year in 2022. There was massive wealth destruction, and yet the cost to hedge going forward hasn't really changed, Kirsch added. Now, comparing the VIX 2022 performance to 2008 recently led Michael Kramer, founder of Mott Capital, to conclude that the gauge may indeed be broken. Others have pushed back against this notion, arguing that while the VIX has been somewhat low, it's still elevated compared to recent market history. Its record low was on November the 3rd, 2017, when the volatility gauge closed at 914. This occurred at a time when US stocks were drifting consistently higher, and the S&P 500 went on to finish 2017 with a gain of more than 20%. It's been a high VIX year in 2022, but not just as high as some people think it should have been, given volatility elsewhere in the market, said Rocky Fishman, the head of index volatility research at Goldman Sachs. So why has the VIX been so subdued? Well, Cox, Kirch and others rattle off several factors that might be contributing to its malaise. One popular explanation is that institutional investors dumped stocks and shifted more of their portfolios to cash this year. They were left with smaller levels of long equity exposure in need of hedging. The VIX is basically a measure of demand for hedges by the biggest investors in the market, but when institutional investors are liquidating their equity positions, they no longer have a need for the associated hedges, so they unwind those positions in the derivatives markets, and ultimately that pressurizes the VIX, said analysts at Sevens Report Research. And also, a generally bearish outlook for markets means that institutional investors are fairly well hedged, Kerr said, which helps to keep a lid on the VIX when large sell-offs materialise. Others cite traders' increasing reliance, though, on short-term options for tactical trades. While the VIX is designed to interpret increased options buying as a sign that investors are growing more anxious, it specifically incorporates only options with roughly 1 month left until expiration. This has become an issue as trading in short-dated options, including contracts with less than 1 day left until they expire, has surged in popularity over the last year or so, according to data from Goldman Sachs. Trading in the so-called zero-day to expiration S&P 500 options had surged in the fourth quarter of last year to more than 4 times its average in 2021, according to data from Goldman. The VIX doesn't accurately measure fear these days because there is so much trading in short-dated options, said Steve Sosnick, chief strategist at Interactive Brokers. Since the beginning of 2022, trading in options contracts with 1 day or less until they expire has exploded. Traders call these products zero DTEs, short for 0 days until expiration. In other words, the VIX no longer offers a complete picture of how volatile traders expect markets to be. The VIX is still measuring what it's intended to measure, but this is more a story of how much the options market has evolved over the past years, so people just aren't using classic 1 month options to hedge or speculate as much. Investors are in fact choosing to get more precise with their option strategies, which makes more sense, is cheaper and more adaptable. So now enter a new index, as US investors will be getting a new stock market fear gauge on Monday when the CBOT rolls out an index that will track implied volatility using option contracts with less than 1 day left until expiration. The new product, the CBOT 1-day volatility index, will be disseminated beginning on Monday, according to a note on their website. Most zero DTE trading is done using option contracts linked to the S&P 500 or the SPDR S&P 500 Exchange Traded Fund SPY, according to data from Goldman Sachs. But investors can trade weekly options contracts expiring every day of the week in other popular equity indices, including the Nasdaq 100 tracking Invesco QQQ Trust Series ETF. The timing of the new release comes as the zero DTE trading volumes has been rising, and trading in zero DTEs has climbed to 43.4% of total option volume. An increase has been driven by a surge in buying of calls, according to data from Stuart Kaiser, Citigroup's head of US equity trading. Call options expiring within 24 hours now represent more than half of all equity call buying over the past month, Kaiser said, and call options gives the holder the right, but not the obligation, to buy the underlying asset at a set price by a certain time, and they can be used to bet that a given index or security will rise. So there are 2 takeouts from here. The first is you cannot rely on the volatility index, the VIX, as a reliable indicator of potential changes ahead, because so much now of option trading is not captured in the VIX. It'll be interesting to see how the new index moves up and down and whether it actually gives a better signal. But the broader point I want to make is that so much of the industry now is being influenced by options trading, and of course options trades are designed to make profits for those who trade in them. As a result of all this, I conclude that this is yet another example of the financial system eating its young, as it were, and not necessarily giving a fair indication of what's really going on. The bottom line is, I believe the markets are in a much worse position than the VIX would actually have us believe, which is why I still think more market falls ahead are likely to come through. And it may well be that the new VIX indicator, the 1-day indicator, will give us a better read, but we'll have to watch and wait and see. But If you are one of those who believe that the markets have bottomed and everything's great, look again. The signals are there for those who want to see them. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.